Hi, Jim Gore from THOR Investment Management. We have a four-step process for investing, and I want to go over the first two processes that we use and how they show up in today's market. First thing is we have proprietary models on the fixed income and the equity market that we use here at THOR that tells us whether we want to be risk on or risk off in the portfolio. The first one I want to talk about is our equity models that we use, which we call the THOR decks. This takes into account both fundamental and technical analysis to tell us if the market is cheap or is it expensive. And as you can see over the last couple of years, it was elevated. Anything over 70 is elevated, which means that you have to be very careful because the market is risky. Just because it's risky doesn't mean it can get more expensive. We saw that happening, but as we've seen as the markets come down, a lot of those gains in the last year and a half, 2 years have been wiped away. That model we use to tell us whether we want to be in the equity market overweight or underweight. We're still going to have money in the equity market even when it was high because you can still find values, which goes to our second analysis, which we look at over the long run, whether you own international, small company, value, emerging markets, over a 25-year time period, you're going to get similar rates of return. However, there are times when certain ones have underperformed that you can move more money in to get a little bit higher rate of return over the next several years. I want to talk about MLPs. MLPs are master limited partnerships, pipelines, if you will, midstream pipelines. And you can see over the last 3 or 4 years, they have underperformed not only U.S. market, but international markets as well. And we think that they're about ready to turn. And so far this year, they are doing much better than the rest of the market, and we think that will continue. The good thing about it is if you're worried about the market correcting like it did back in 2000 or 2007, you can see that MLPs in that time period when the market was at a higher level of risk significantly outperformed the U.S. stock market, and that is why we have MLPs in our clients' portfolio at this time, because they're relatively cheap and also with high valuations, they tend to do much better than U.S. stocks going forward.